Hi everyone. In today's class, we are going to be discussing the concept of relevant cash flows in capital budgeting. In the determination of financial viability of a project, there are three variables that must be present. One is the useful life of the project. Two is the appropriate cost of capital of the company. Then three are relevant cash flows. For this purpose, relevant cash flows are cash flows of receipt and payments that are directly attributable to the project under consideration. I repeat, relevant cash flows are cash flows of receipt and payments that are directly attributable to the project under consideration, which means that any cash flows of receipt and payment that will not be received or paid as a result of undertaking the project should not be considered. Hence, in evaluating a project, the following line items should be critically examined. One is variable costs. Variable costs are costs that vary according to the activity level. This means that the more the number of units produced, the more the total variable cost that will be incurred. However, the variable cost per unit will remain constant. Examples of variable cost include number one, direct material. Okay. Number two, direct labor. Number three, direct expenses. Then number four, variable overhead, variable production or factory overhead. So these are the four examples of variable costs. So when you see direct material, direct labor, direct expenses, or variable overhead in a question, they are relevant, you should consider it. All right. So let's move to the next one. Another variable you should take into consideration or you should examine critically is the fixed cost, because there are different ways in which examiner can test fixed cost in a question. When you talk about fixed costs are costs that have no sympathy for activity level, which simply means that irrespective of the activity level, the fixed cost will not change. Provided the fixed cost will not change, it is irrelevant. However, if the fixed cost will change as a result of undertaking the project, then it is relevant. So there are three different ways in which examiner can test fixed cost in a question. If you are given a fixed cost, no further information, that fixed cost is irrelevant. Just ignore. Say, for example, you are just given a fixed cost of 100,000, no additional information, no further information. That means that 100,000 is irrelevant, you ignore it. The second way examiner can test fixed cost is you may be given fixed cost, including depreciation. So when you are given a fixed cost that includes depreciation, that fixed cost is irrelevant. However, you need to go ahead and determine the annual depreciation. Once you get the annual depreciation, less from the fixed cost, the difference is relevant. Then the third way examiner can test fixed cost is if you are given a fixed cost excluding depreciation. Once you are given a fixed cost that excludes depreciation, it is relevant and you should consider it. So these are the three ways in which examiner can test you under fixed cost. Then the next item would then be incremental fixed cost. If you are given incremental, attributable, direct, specific fixed costs, they are all relevant cash flows and they should be considered because they are related to the project. Then the next item would then be historical cost. Historical cost is a sunk cost. Historical cost represents the original cost of the item. Therefore, historical cost is a past cost that have already been incurred and should be ignored in a question. Examples of sunk costs include development costs, market survey costs, market research cost, or any feasibility study cost. All these are past costs, irrespective of when the payment will be made. Provided the activities has been done, then it is irrelevant. You ignore. So whenever you see sunk costs, past costs, historical costs in a question, they are irrelevant and they should be ignored. The next item is depreciation, amortization, or provision. Depreciation is a non-cash item. It's not a cash flow. So whenever you see depreciation, amortization, or provision in a question, they are just notional costs. Therefore, ignore them. They are not relevant. Depreciation, amortization, provisions is not relevant. Ignore when you see it in a question. Next item will then be interest. The absolute amount of interest is irrelevant because the cost of capital to be used to evaluate the project already included interest. So whenever you see the absolute amount of interest in a question, you just have to ignore it because it is irrelevant. If you include interest in a question, if you include the absolute amount of interest in a question, it will mean that you are double dipping. When you are double dipping, it means that you are treating something twice. Okay, so you are double dipping, which means the treatment of something twice. When you treat something twice, it means that you are double dipping. So when you see, say for example, you are given interest of 10,000 naira. Okay, so this interest of 10,000 naira is irrelevant because the cost of capital you want to use to discount the future cash flows of the project already included interest. So when you now consider this absolute amount of interest, it means that you are treating interest twice. So whenever you see interest in a question, please ignore, it is irrelevant. Then the next item will be the opportunity cost. Opportunity cost is a benefit forgone as a result of undertaking a project. Opportunity cost is a relevant cash flows and should be considered. What do you understand by opportunity cost? For example, if I'm a lecturer and I have a car, if I choose to drive myself, I can use that car for Uber service. I can also drive the car to the center to undertake my lectures. So if I choose to drive myself to the center, that means I won't be able to earn the benefits that would have accrued to me through the Uber service. Therefore, the opportunity lost, the opportunity I've forgone, the benefit that would have accrued to me through Uber service is gone forever. So when I now want to determine the cost of my lecturing, the benefit that I've lost should be part of the cost of my lecturing. That is opportunity cost. Okay? And the last item we need to discuss is working capital. Working capital represents the difference between current asset and current liability. Okay? Working capital represents the difference between current assets and current liability. It is also called the amounts required for the day-to-day running of a business. All right. For example, company will need money to purchase inventory, supplies, stationaries, pay salaries, pay suppliers, and all of that, or settle short-term obligations as they become due. Therefore, all this money that the company needs to run the business on a daily basis is what is called working capital. So working capital is a relevant cash flow. Whenever you see working capital in a question, you should consider it is relevant. However, there are two different ways in which you can treat working capital. One is that, number A, if you are given a one-off working capital, okay, one-off working capital. Okay, how do you treat a one-off working capital? A one-off working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. Say, for example, there's a working capital. For example, if you are given a working capital of, say, 5,000 naira in year one, so how do you then treat this working capital? The rule says that working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. Say, for example, the useful life of this project is 3 years. Therefore, I would then say year 0, year 1, year 2, then year 3. Okay? Now, because this working capital of 5,000 naira occurs in year 1, I'm going to treat it as cash outflow in year 0, working capital. So I will not record it in year 1. Rather, it will be in year before year 1 is year 0. So here will be 5,000. So it should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. The useful life of this project is 3 years. Therefore, I will recover the working capital. The working capital should be equal to 0 at the end of the useful life. However, the PV of each respective working capital will differ. All right. So this is how to treat a one-off working capital. Again, say for example, this working capital will occur at the end of year 3. For example, it will occur at the end of year 3. Therefore, it should be treated as cash outflow in year 2. Okay, it should be treated as cash outflow in year 2. Here is year 2. I would then say 5,000. So at the end of the useful life of the project, which is year 3, I will recover the entire 5,000. So my working capital will then become 0. All right. So this is how to treat a one-off working capital. What if you are given incremental working capital? Number B now. Incremental working capital. How do you treat incremental working capital? The incremental working capital should be treated similar to a one-off working capital, only the increment should be considered. Say, for example, you are given this kind of working capital. So year 0, year 1, year 2, year 3, then you have total. All right. Say you have a working capital of 1,000 in the first year. It has increased to 1,200 in the second year, then 1,500 in the third year. So you notice that the highest working capital is 1,500. That is the maximum. So in this case, the 1,200 and 1,500 are irrelevant because I need to determine the incremental working capital. Therefore, I would then say incremental. Okay, incremental working capital. So the first working capital of 1,000 still remain valid. Here will be 1,000. The 1,000 has increased to 1,200, difference of 200. The 1,200 has increased to 1,500, difference of 300. Therefore, 1,000 plus 200 plus 300 will give me a total of 1,500. So the rules there says that working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. Therefore, relevant year will then be the 1,000 working capital in the first year will be treated as cash outflow in the year before the year of occurrence. So year before year 1 is year 0. The one of 200, of course, cash outflow. The one of 200 should be treated as cash outflow in the year before year 2. Year before year 2 is year 1. Here will be year 1. The one of 300 should be treated as cash outflow in the year before year 3, which is year 2. Then at the end of the useful life, which is year 3, the entire working capital of 1,500 should be recovered. Okay, so this is how to treat incremental working capital. Now, what is important is that when you want to ascertain or when you want to evaluate a project, different cash flows will be given. So you have responsibility to be able to identify which of those cash flow givens are relevant, which one are not relevant. And this is where you have responsibility as a finance person, as a financial expert, okay, to be able to evaluate the project. And of course, this is what we have discussed so far, how to identify relevant cash flows in a question. And majorly, the focus is on the variable costs, direct. We talk about variable costs, how to identify relevant cash flow in relation to variable costs. We talked about fixed costs. We talked about incremental, attributable, specific fixed costs. We also talk about sunk costs, depreciation, amortization, and provision. We talk about interest, opportunity cost, and then lastly, working capital. Take time to review this and take it into consideration whenever you want to evaluate a project.